Hey everyone, and welcome! Today, we're going to tackle something that can feel a little chaotic. We're going on a journey to take a total mess of financial data and turn it into a picture of a business's health that's crystal clear. Yep, we're talking about the accounting cycle.
Just think about it for a second. Every single day, a business is just a whirlwind of activity, right? Invoices are flying out, cash is coming in, bills need to get paid, payroll is getting processed. It's a lot. So how on earth do you take all of that financial chaos and turn it into a coherent story that actually means something? Well, the answer is this really elegant, systematic process called the accounting cycle.
Every great story, or in our case, every great financial investigation, starts with gathering the evidence. So this first phase is all about the inputs. This is the raw data that becomes the foundation for absolutely everything that follows.
Okay, so let's get into that evidence. The very first clues in any financial case file are the source documents. You can think of these as the forensic proof. The receipts, the invoices, the purchase orders. They are the undeniable physical proof that a transaction actually happened, which makes sure our entire case is built on a solid foundation of fact.
Now that we've got all our clues, where do we put them? We log them in the journal. This is literally the company's financial diary. Every single transaction gets recorded here in chronological order, like a play-by-play. It tells us exactly what happened, when it happened, and why. And this is where the real magic of accounting starts to happen. We don't just jot down, spend $100. Nope. The absolute core of journaling is the double entry system. It's all built on this fundamental idea that for every action, there's an equal and opposite reaction. Basically, every transaction has two sides, keeping the financial universe perfectly in balance.
Let's look at a super simple example to see what I mean. The company buys $100 worth of supplies, and they pay with cash. Okay, so on one side of the equation, an asset account called supplies goes up by $100, but on the other side, another asset account, cash, goes down by $100. See? A debit and a credit. One asset was just swapped for another, so the total value of what the company owns hasn't changed. Everything stays perfectly balanced.
So our journal is an awesome diary, but it's not super helpful if you just want to know, hey, how much cash do we have right now? For that, we need ledgers. What we do is take all those entries from our diary, the journal, and post them to individual ledger accounts. Think of it like taking all your diary entries and sorting them into specific folders, one for cash, one for sales, one for supplies, and so on. So here's the crucial thing to remember. The journal gives you the chronological story, the play-by-play of what happened and when, but the ledger gives you the big picture summary for each account, the where do we stand right now. You absolutely need both to get the full financial picture. All right, we've gathered all our evidence and we've organized it. Now comes the really analytical part of the investigation, connecting all the dots. This is the processing phase, where we check, we refine, and we get our data ready for the final report. Now, this processing phase has 4 key steps. First, we run something called a trial balance to make sure our basic math is right. Then we make these crucial adjusting entries for things that happened over time. After that, we do closing entries to basically wipe the slate clean for the next period. And finally, we run a post-closing trial balance to confirm everything is set and ready to go. It's this really rigorous process to guarantee our numbers are perfect. So, first up is that trial balance. It's simple, really. We just list out every single ledger account and its final balance. The whole point is to do one powerful check. Do our total debits equal our total credits? If that scale isn't perfectly balanced, that is a huge red flag that we've made a mistake somewhere, and our investigation has to backtrack. But hey, just because the numbers balance doesn't mean they're telling the right story. The next step is all about timing. A business might pay for a year's worth of rent in January, but they're using that space all year long. That's where adjusting entries come in. We make these at the end of the period to account for things like depreciation or prepaid expenses. It's all about matching revenues and expenses to the period where they were actually earned or used. It's super important for getting an accurate picture. Okay, once the period is officially over, we perform closing entries to get ready for the next one. Think of it like this. Your revenue and expense accounts are temporary. They only track your performance for this period. So at the end, we take their grand total, the profit or loss for the year, and move it into the company's permanent records. This wipes the slate clean, resetting those temporary accounts to zero so we can have a fresh start. And our final step in the processing phase is one last check. After all those adjustments and closing entries are done, we run a post-closing trial balance. This is the final confirmation that our books are balanced and that we are officially ready to start the next accounting period with a clean, accurate foundation.
This one is different from our first trial balance, by the way. It only includes our permanent, ongoing accounts, confirming our foundation is rock solid.
All right, the detective work is done. The clues have been gathered, the evidence has been analyzed, and all the numbers have been confirmed. It is time for the grand finale, the climax of our story, solving the case with the outputs. This is the good part.
All of that meticulous work culminates in the financial statements. These are the final reports that finally tell the company's full story. They answer the big questions, like how profitable were we this year? That's your statement of profit or loss. What do we own and what do we owe? That's the statement of financial position. And where did our cash actually go? That's what the statement of cash flows will tell you.
And why does any of this matter? Well, because these reports are the #1 tool for making big decisions. Managers use them to steer the company. Investors use them to decide whether to buy or sell stock, and banks use them to figure out if they should lend you money. They are absolutely critical.
So as we start to wrap up, let's just take a step back and appreciate the simple elegance of this whole process. Why is the accounting cycle so darn important? Because it's a robust, reliable, and logical system. It gives you the structure you need to take thousands of raw, chaotic transactions and transform them into clear, accurate, and actionable intelligence. It literally turns financial noise into a story that anyone can understand.
And that brings me to a final thought for you. The cycle gives us all these incredibly powerful reports, which is fantastic, but it kind of begs a question, doesn't it? Is there one single statement that tells a more important story than all the others? Or do they really only make sense when you read them all together? Something to think about.